Thank you, Mantesh, and good morning, everybody. Good afternoon, sorry. So we will, so let me share the screen. Okay. Okay, is this visible now?
Yes, sir. Yes, sir.
Okay, sir. Okay. So good afternoon, Professor Uchagwada sir, Rangappa sir, and all the research scholars and participants who are uh, who are now online for the lecture. So now in this lecture, I'm going to discuss on the volatility models, that is the ARCH and GARCH models, which are termed as volatility models, and which these models are widely employed and widely used in financial econometrics, as in financial economics, in predicting the risk as well as in predicting the returns, in analysis of returns of an asset, any financial asset. So we all know that ARCH is autoregressive conditional heteroscedasticity model, and the further the family of ARCH models are GARCH model, generalized autoregressive conditional heteroscedasticity model, and there are other variants of ARCH models also available in literature. So these models are eGARCH and mGARCH. So in this lecture we will be focusing the theoretical aspects of ARCH and GARCH, how we are going to derive this. So the main intention of this lecture is to show the derivation part, because the estimation part is very easy once we understand the theoretical part, and the derivation of conditional heteroscedasticity and the unconditional heteroscedasticity, which which is very important in volatility models, ARCH models. So in this lecture, I'm going to present those aspects. So without taking much time, so let me start the introduction to the ARCH models. So we all know that this, uh, how to hide this? Okay, so we all know that Arch and GARCH models are very important models in time series econometrics. Generally, these models, as I already said, these models are employed in financial econometrics in analyzing the risk of a financial risk of an asset, whether it may be a stocks or any exchange rates, or any asset, analyzing volatility in the asset and its return in financial markets. So nowadays, we see many empirical papers which are widely using these models in analyzing the financial markets. And most often, we know that the behavior of the financial time series, such as stock prices, interest rates, exchange rates, and inflation rates, even if you take the gold prices, these time series exhibit a lot of volatility. These data always exhibit volatility. In addition to this volatility, these data also carry the phenomena of volatility clustering. So not only these data have volatility, but this volatility is also clustered. That means the financial time series data, this time series data is its volatility is clustered. So we'll define what is cluster, and how we are going to measure this volatility and all this. So the cluster, the basic, in general terms, the cluster volatility clustering is nothing but, suppose if we have a financial variable, if you take any particular financial variable, whether it may be a stock prices or interest rate or foreign exchange rates or inflation rates, these data, time series data, exhibit wide swings. Wide swings in the sense, it will be, there will be considerable ups and downs, and it is also it will also experience a period of calmness in its behavior. So there is high amount of ups and downs in one side, and the other side there is high amount of calmness in its behavior also. So theoretically, this type of behavior of a particular variable is termed as volatility clustering. Volatility clustering. So these types of swings are generally unpredictable, and swings or volatility is unpredictable, and it will be having serious consequences to both the real economy also, as well as for the financial market. So we all know, we have studied that volatility will be having serious consequences, serious effects on the real economy as well as for the financial markets. So why we are concerned about volatility is that suppose you take an example of an investor. So because that investor is not only concerned of its return, but is also concerned about uh, the variability of that asset. Suppose if we consider the behavior of if we take this as an example, the behavior of an investor as an example, average investor as an example, that investor is not only concerned about the rate of return for his investment, but is also concerned about the risk of that investment, as long as there will be variability or volatility in that risk. So that means in his holding period, how that the return will variable, it is going to vary. So that is how it is going to be volatile. So it is therefore, it is very important to understand and measure the asset price as well as the asset returns volatility. So we have to measure the asset price also, as well as we have to measure the asset returns volatility, how it is volatile. So theoretically, a general and a simplistic measure of volatility is variance. So we can measure the variance of an asset return uh, over a period of time. So this is a simple variance is a simple measure of volatility. For example, suppose if we have a data of a particular stock returns over say a period of 1000 days. Suppose if you have collected a data of a particular stock and its a return for 1000 days, we can calculate its variance of daily returns by subtracting the mean value of the stock returns from its individual value, square the difference, and we will divide the number. So divide by the number of observations. So that is what the formula of the variance. So we can calculate the variance. So but this variance, it do not capture the volatility clustering. The simple measure of volatility is, though it's a variance, but this variance, it do not capture volatility clustering, and it also do not take into consideration the past history of that returns, because current returns of a particular asset, it depends upon its past behavior or its past history. But if we take the simple measure of variance as a measure of volatility or an indicator of volatility, it does not capture this volatility clustering. Because why it does not capture volatility clustering? In the sense, in theory, we all know the conditional variance and unconditional variance, conditional variance and unconditional variance. So but this variance is a measure of what it is called as an unconditional variance. So that is, it gives a long term period value. It is an unconditional variance. Previous, as I said, as I mentioned previously, it is because the variance is measured as the sum of deviations, deviation of individual returns from its mean and divided by the number of observations. It is the formula of the variance. As we all know that in financial time series, volatility clustering is common. So we all know that, especially what I said about the stock returns, exchange rate. So in all these financial time series, volatility clustering is common, and it describes this cluster describes the tendency of large changes in asset prices to follow with large changes, small changes in asset prices to follow with small changes. small changes. So this is because, as I already mentioned, that the inherent characteristics of the financial time series is that it exhibit high amount of volatility, and that volatility is going to be clustered. The clustered in the sense it will be have a tendency of large changes to follow with large changes and the small changes to follow with small changes, and there will be relative calmness also. That was the characteristics of any time series, financial time series data. So in that case, we can say that these changes are autocorrelated. So when we say that asset prices, the large changes in asset prices are going to be followed with large changes, and small changes tend to follow with small changes. That means, so the overall changes, we can say that the volatility is autocorrelated. That means it is influenced by its previous values. In other words, the current level of volatility is positively correlated with its preceding time periods. So it is when we say autocorrelated means whatever happening for that asset returns in the previous year, it is going to have a correlation with the current time period, and we can say that this volatility is autocorrelated. So in arch models, generally in arch models as well as in GARCH volatility models, we will find both autocorrelation as well as heteroscedasticity also. So for that reason, we call it as autocorrelated conditional heteroscedasticity model. Here, conditional in the sense we are going to use a conditional variance instead of an unconditional variance, which I am going to explain in the later stages, what is conditional variance and unconditional variance. So heteroscedasticity is nothing but variance. So in other words, the current level of volatility is positively correlated with its preceding time period. And this type of situation, we cannot use, so we cannot, when we have this volatility clustering and this volatility is depending on its past values, in this case, we cannot use variance uh, as a measure of volatility or an indicator of volatility, because it is going to create its own problems. Because that simple measure of volatility, it does a measure of variance, it does not take into account the past behavior of a particular asset, and it is not time varying. So it is going to be a constant value. So what we need is a time varying volatility. We have to take into account the time varying nature of the time series of the assets. So in this case, we have to use an alternative method, or we have to use a alternative volatility models. And these volatility models are autoregressive conditional heteroscedasticity class of models, which have been developed by Angel in 1982. So a measure which takes into account all these volatility aspects are the autoregressive models. So so why, in the sense, the concept of volatility in economics and economic and financial time series, this led to the development of autoregressive conditional heteroscedasticity models, which I have already told, and these models have been developed by RF Angel in 1982. Uh, these models, these volatility models not only helps to model the attitude of investors, but it also helps to model the expected return. It not only helps to expected returns, but it also models helps us to model towards the risk attitude of the investor on the expected returns, but it also helps us towards to measure the risk. So these requires models that are in order to model the attitude of investors on the one hand, and the other hand, we also need to model the expected returns, and also we have to model the risk and uncertainty. So in this case, we have to have uh, uh, different class of models, and these models are what we are going to study now is the arch models. Family of models are going to be employed. So we all know that in conventional econometrics theory, or in the theoretical sense, in the conventional econometric theory, assumes of homoscedasticity. That is, the variance is not going to change over a period of time. That is constant variance. But uh, but however, most of financial and economic time series, these time series exhibit a periods of high volatility followed by a more quiet period of low volatility. So in that case, the variance cannot remain constant. So practically, it indicates that the conventional homoscedasticity or equal variance principle, it will not apply for financial and economic time series data where there is more volatility, because they are time varying. So time varying in the sense the variance should also vary according to time. So but in contrast to this, our what we have studied in the classical econometric theory, it assumes that of homoscedasticity. So why? Because in financial and economic time series, the changes are influenced by past record of changes. That means the past behavior will affect the current changes, and hence the variance cannot remain constant. Suppose today's stock price is influenced by the previous year stock price plus a random stochastic behavior. Like that, the current exchange rate, today's exchange rate, it depends upon the previous day's exchange rate plus a stochastic error. That means the variance, it is influenced by the past behavior. So in this volatility models, the variance which we are going to study, it depends on the past behavior, and hence it does not remain constant. Uh, Hence it cannot remain constant, and we termed it as we have to follow the heteroscedasticity. Therefore, in these types of cases, it is clear that the assumption of homoscedasticity is very limiting, and hence in volatility models, we allow the variance to depend on its history. That means we allow for heteroscedasticity instead of homoscedasticity in the volatility models. So why? In the sense, so I will give an example of an investor. Before going to take an example of an investor, suppose uh, we all know that we have to estimate uh, based on some condition. So conditional to the past behavior. So this is the behavior of today's stock price. So suppose if I want to measure the exchange rate, means conditional to previous day's exchange rate. This is the today's exchange rate behavior. So we have to take into consideration the conditional behavior here. So when whereas in theoretically the unconditional is related to a long-term perspective. So in this case, uh, the assumption of the classical assumption of homoscedasticity equal variance is of a limited application in time series econometrics, and we all know that uh, for that reason we are going to violate that assumption. Suppose if I want to give an example, suppose we will consider an investor who is planning to buy an asset at time t period. So he will buy an asset, any financial asset at time t period, or and he wants to sell that asset in t plus 1 period or t plus 2 period. So during that period, he will be holding that asset. So here that investor is not only not only thinking of the expected return of that asset, price of that asset, but also how it is going to vary during the holding period, how it is going to fluctuate, or how it is going to be volatile, the price of that asset being volatile during that holding period. So in this case, we have to examine not on examine the conditional variance of the asset and the riskiness of the asset. So how it is going to change, the variance is going to change, and how much it is risky. So we have to measure that. So in order to measure these return aspect as well as the riskiness of the asset, we generally use the arch models. Hence, because of this, the financial time series generally observe that observe about autocorrelated heteroscedasticity, because the error terms are correlated, autocorrelation, and the heteroscedasticity means the variance is, current variance is influenced by the previous year's variance, previous day's variance. So that is, the variance is changing or unequal or time varying. So for that reason, so most of the Arch and GARCH models are termed as autocorrelated heteroscedasticity, and that is heteroscedasticity in different periods is autocorrelated. So not only the variance is autocorrelated in this models, in these types of model, and for that reason it is called as